Imagine if the topper in your class suddenly got like 60% in an exam. Wouldn't you have freaked out? Like, what's going on? Was there a mistake? And if the topper got 60%, what's going to happen to the rest of the class? When Fitch decided to downgrade the US in August, it was one of those kinds of moments. And look, if you're wondering what happened, why did it happen, why is this a big deal, and what does this all mean? Well, this video is for you. So first things first, there are three major rating agencies globally: Standard & Poor, Moody's and Fitch. And they not only rate countries, they also rate companies, financial institutions, basically any entity that is borrowing money. Why? Well, because investors want to know the risk attached to what they're investing in. So suppose tomorrow India wants to build a highway. It tells investors, please buy our bonds, we'll pay you X% interest. Now, what are the chances that the next day the government of India says, oh, sorry, too bad, I can't pay you back? Because if those chances are high, then investors would naturally want higher levels of interest rates. So how can an investor objectively know, is India safer than, say, Pakistan or China or Vietnam? Well, they rely on these ratings. Rating agencies in turn study a country's growth, its inflation, how strong its banks and financial institutions are, how much debt it has accumulated, how much the government is borrowing every year. Is that borrowing even sustainable? What about political stability? Can the government take decisions easily, or is it hanging in there by a slim majority? Is it undertaking reforms, or is it taking wrong economic and political decisions? How is national security, the strength of institutions? So rating agencies take all of this info and then give a rating. So in the case of Fitch, for instance, the top credit rating a country could get is AAA, which means that your money is super safe. Then there's AA, A, BBB, BBB minus. All of these are what are known as investment grade. Anything below it is speculative grade or junk. By the way, India is BBB minus, so just one level above junk. And the government of India has for years been trying to lobby these rating agencies, saying that look how fast we are growing, look at how well we are managing our economy, look how we are trying to control our debt, we deserve a higher rating. For reference, at the time of filming this video, Pakistan's rating by Fitch is CCC, so in deep junk territory, which means investors demand higher interest rates as compensation when investing in Pakistan versus India. And by the same logic, China is A+. So India has to pay a higher premium for the same money compared to China. Now, why is this US downgrade such a big news? Well, because dollar is the most recognizable currency. It's a reserve currency. It's supposed to be super safe. People use the dollar with the confidence that the US is a fundamentally strong and stable economy, that it won't ever default on its obligations. In fact, whenever a crisis happens globally, investors tend to rush to buy US bonds and exit emerging markets like India. Because the logic is that a AAA rated country is a safer place to park your money at times of stress than a BBB minus country, for instance. But if the world's most popular AAA country is not as creditworthy, what will the investors do next? But before we get to that, the big question is, why was the US downgraded? Well, three reasons. First, the US has been overspending according to Fitch. The fiscal deficit, which is the total expenditure minus the total revenue. So this is essentially what a government has to borrow every year, is too high according to Fitch. So the US government went on a spending spree during the pandemic. Its fiscal deficit ballooned to nearly 15% of GDP, which is enormous by US's own historical standards. But hey, money doesn't grow on trees. You not only borrow that money, you also have to pay interest on it. Fitch is saying that US's debt, which was around 100% of GDP before the pandemic, shot up to over 122% of GDP in 2020 because of all this government spending. It has come off, but it's still elevated at 113% of GDP, so still above the pre-pandemic level, and set to rise to 118% of GDP over the course of 2023 to 2025. And just to give an idea of how bad this is, the average national debt of AAA countries is around 40% of GDP. The second reason, Fitch describes this as an erosion of governance. So the US recently had a major political confrontation between its two key parties, President Biden's party, the Democrats, and the Republicans. Now, the Democrats control the Senate, which is like their upper house, But the Republicans control the House of Representatives, which is the equivalent of a lower house. And so it becomes really difficult for anyone to agree on anything. And matters came to a head in around May and June when the US had the debt ceiling crisis. So the US has this weird system where they have a debt ceiling, supposedly to encourage the government to control its spending and keep the debt, well, as the name suggests, under a ceiling. However, what actually turns out is the US just keeps breaching this ceiling and then legally setting a new ceiling. And if it is not raised, well, then technically the US government will have to shut down and start to default on its loans, which would be tantamount to a financial Armageddon, not just for the US, but also for the rest of the world. And because the stakes are so high, the opposition essentially can arm twist the government to add or subtract policies that are being funded. And very often these negotiations go down to the wire. In the past, there have also been situations where the US government actually had to shut down for a few days before a compromise got worked out. Incidentally, the Fitch had already warned earlier in the year that this kind of political fights will cost the US its AAA rating. As a matter of fact, when a similar situation arose back in 2011, Standard & Poor, the other rating agency, had first downgraded the US, hence the title of this video, Another One Bites the Dust. And 3, Fitch thinks that the US is walking into a recession. The central bank has raised policy rates from nearly 0% levels to possibly 5.5% to 5.75% by September, according to Fitch, which is huge. By the way, we had done an episode of the Bond Economist on the Federal Reserve some time back. I'll leave a link of the video at the end of this. Please do check it out. Along with this, inflation still remains elevated. So Fitch believes that the US will experience a mild recession from Q4 2023. That's the October to December quarter, which will last up to March 2024. So when you combine these 3 factors, Fitch is essentially saying, look, US, you really don't deserve to be a AAA country. But what does this actually mean for the US and the rest of the world? So when a country typically gets downgraded, investors pull their money out of it. So its stock markets tank. People dump their government bonds. So the price of the bonds fall. And then because that is inversely related to interest rates tend to spike up. Another way to think about it is that investors now need higher interest rates to remain invested in these bonds. And because everyone is selling off their investments in that country, well, the currency tends to depreciate. So you would expect all these to play out for the US too, right? Wrong. As they say in Hindi, baap baap hota hai. US is like, अरे हमें छोड़ के जाओगे कहाँ? Where else are you going to invest? So back in 2011 also, when the first downgrade by Standard & Poor happened, people got so scared that they withdrew their money from stock markets. So the US stock markets fell and markets across the world got impacted. And then investors put it back into the supposedly safe US government bonds. So instead of US interest rates going up, they actually went down. So other countries end up suffering as a result of a US downgrade. This time the reaction has been much more muted. Yes, US yields are going up, but there's a bunch of other reasons to that. The US has a lot of borrowing planned in the coming months. The latest employment numbers still remain strong, and there still is expectations of more interest rate hikes by the Federal Reserve. Also, the Bank of Japan is now ready to tolerate higher interest rates, in turn putting pressure on rates globally. Again, we've done a video on this. I'll leave the link at the end. Please do check that out too. And yes, on the margin, there may be some movement. So there are some funds that are only supposed to invest their money in AAA bonds, who will now have to rethink their investments given that 2 of the 3 rating agencies have already downgraded the US below AAA. So it's technically no longer AAA. But overall, it's not been that disruptive. Having said that, that still doesn't mean that everything is hunky-dory. These are like warning signs. They're telling you that the US economy is borrowing too much too fast, that it could hit a recession soon, that there are some really big problems in the medium term. And for a world that is already itching to reduce dependency on the dollar, Fitch is essentially telling such people, you know what, that's not that crazy of an idea. For more such insights, like, share, and subscribe to the Bond Economist.